I bought my first house when I was 19. I'm extremely wealthy in real estate because of starting at age 19. And my entire family never owned a home, and none of them are wealthy. If people don't buy now and they wait for rates to drop, the truth is, the problem with today's society and the young people today, but rates were 4.5% 3 years ago. Well, yeah, they were the lowest they've ever been, ever. They don't even know about 18% rates like 1983 and 84.
Exactly.
You go to Russia, you have to pay cash for a house. That's why no one lives in houses in Russia. Even Putin lives in an apartment.
Wow.
And so I always tell people, look, there's vowels, A, E, I, O, U. Appraisal, earnest money, inspection, option fee. It's all up front. And guess what?
Hey everybody, welcome back to the channel. If you're new here, I'm BC Onitiri, your real realtor for all things real estate in Houston, Texas. Now today we've got a phenomenal guest who is going to drop some serious knowledge that you wouldn't want to miss. Joining me is an expert lender with over 20 years of experience in the real estate game. We're diving deep into mortgages and real estate investments, specifically tailored for you self-employed go-getters, first-time home buyers, and married couples out there. Ever wondered whether it's better to buy or rent in the ever-changing Houston market? Our guest today has some mind-blowing insights on interest rates that are guaranteed to change the way you think about home buying. And that's not all. We're taking you through his incredible 20-plus year journey of homeownership. You'll hear firsthand how he navigated the ups and downs and came out on top. Plus, we're breaking down a step-by-step guide on everything you need to know before taking out a mortgage. Now trust me, you'll want to grab a notebook for this one. And hey, if you're eager to learn more, comment list below to get a link to our exclusive home buying seminar launching very soon. So stick around, hit that subscribe button, and let's get started. And I'm here with a very special guest, a good friend of mine who is a guru in the mortgage industry, Michael Harrington. Please, let everybody know a little bit about you.
Sure, no problems. Michael Harrington with Cross Country Mortgage. I've actually been in the mortgage business now 29 years, branch manager out here in Katy, Texas. I've been in the top 1% of mortgage originators since 2002.
Wow.
And top producer for my company. Number one on Google for 5-star reviews in the West Houston area. We pride ourselves on the service we deliver. My team's incredible at communicating with not just the buyers, but also the real estate agents involved, and pride ourselves on knowledge of everything from first-time home buyer programs, down payment assistance programs, and more importantly, how to handhold everyone from a first-time home buyer to elderly that are getting out of their last house and maybe going to assisted living. We handle everything in between. So all residential. I don't touch commercial. I stick to my lane, which is residential mortgages. Been doing it a long time. So I always tell people when they compliment us on what we do, I just say, hey, after 29 years, if I'm not good at this, I should have changed careers a long time ago. So.
Well, I can definitely attest to it. You are great at what you do because, you are on top of it all, because most times when I bring clients to you, it's like you know exactly what to tell them and you know how to just sift through everything. So I have to commend you. So, Michael.
Thank you. I appreciate it.
Oh, it's no problem. Before we get into this, I always start by asking my favorite 3 questions. The first one is, are you happy with where you are?
It's funny. I was just reading a book called The Gap and the Gain, and trying to live in the gain and not live in the gaps. And they talk about happiness and how to live to be content. I've learned to be content only in the last 5 years. I have to say, before that, I was always hungry for more and more and more and more. But ironically, because I am content, I'm happy with my family, the balance I have with my wife and kids and business, because I've learned to be content, not need more. The irony is more has been happening because I have not been pushing it. Like, it's been happening more naturally, which is incredible, and has allowed me to be just the word content. I mean, my faith allows me to be more content as well. Because I'm more faithful to God, and I think He's faithful to me. It's been an incredible journey in the last 5 years that I feel I've learned to balance, but also gain perspective on the fact that I don't need more. Therefore,
Right.
uh, if business was less last year than the year before, I honestly didn't care. As long as the bills got paid, we were stashing a little bit of money away for savings. I didn't care about last year. Last year was horrible for a lot of people. For me, it wasn't. And I think that was all about my perspective versus their perspective and just being able to be content.
That's great.
Right.
Now, the follow up question is, what's your why and what's your biggest motivation?
Well, because I'm content, it's funny because my why has changed drastically in the last couple of years.
Right.
My why is really much more to help people, people that just didn't know anything about whether they could or couldn't buy. My why is definitely to help people understand finances more, understand budgeting, understand their capability of purchasing a home
Okay.
versus not. So I would say a lot of people probably think, your why is vacations and money. And I find that there's no legacy in that. So I would say my why is to have a legacy of education for my homeowners so that they will in the end have plenty of investment properties, making them plenty of money where they won't have to work. They can retire, have maybe 5 to 10 investment properties, paying them a cash flow that is wealth building.
That's wonderful. Now, next to the last one, well, not the last one, the last intro question, which is, what is your biggest fear?
Fear. Um, my biggest fear is the fear of missing out. Like I have bad FOMO. I always think I'm going to miss out on something. So like my health right now, I'm recovering from pneumonia, which has me breathing a little bit more in between, which
Oh,
is probably good for things like podcasts because I'm not talking too fast. But I guess the fear I have is when I had my health issues is like, what would happen if I wasn't here? Like, what if because I wasn't taking care of my health or my body, I'm here for less time. So my fear of missing out on my kids, graduating from college, going to, getting married, having grandkids in the future, like I don't want to miss out on that. So I would say that's just that my fear is the daily struggles of health is your wealth. I mean, I'm more focused on that right now.
Wow, that's amazing. That's amazing. A round of applause. Now, we understand the way the market is. It's been very interesting to say the
Yeah.
least. And what to me I find amazing is sometimes we think we understand our ideal client profile. We think, okay, this is the kind of people that are coming to the market. These are the people we need to target. And then we find out that no, we don't get to dictate who is interested in the market. And what I have noticed is that there's a lot of newlyweds. There's a lot of people coming in first time home buyers. So I kind of want to educate people when they're on that journey. And sometimes they might not be first time home buyers. They might be people who own a couple of homes, but now they've gotten married, or some have gotten divorced and now remarrying. And their question now is, how do we navigate this complicated web? So I guess my first question is, what can a newlywed couple looking to buy their first home be most concerned about?
What they should be most concerned about is saving at least enough money to handle the initial portions of down payment. So people hear things like zero down, no down payment, the word zero, like there's literally zero on all these signs. But the unfortunate part is you do have to have some money initially set up to even start the process. And so with newlyweds or people that are buying their first home, I always ask them, let's say you're getting into a rental and it's $2,500 rent
right.
plus first month's deposit. How much is that? That's $5,000 that they have to come up with. I'm like, obviously, if you're buying a house, you're going to have to come up with something. I said, and 5,000 is actually a really good starting point if you're not going to put any money down on a particular type of down payment assistance program. But it would be smarter to obviously save more than that. But coming to the table of like going out and house hunting without at least $5,000 sitting in the bank for that purpose is putting the cart before the horse. I always say if you've watched Wheel of Fortune, I know Pat Sajak just said goodbye to Wheel of Fortune after 40 years, so it's fresh on people's minds. If you remember, there's vowels, AEIOU. And so I always tell people, look, appraisal, earnest money, inspection, option fee, and it's all up front. So that's AEIOU. So I tell realtors, if you can remember the vowels to tell your clients, that, hey, you're going to have to appraisal. That's $750. Earnest money is 1%, 300,000. That's $3,000. Now we're up to 3750. Your inspection, 450, $500. Okay, now we're up to what, $4,250. And then your option fee, usually $200 to $300. So again, pushing that $5,000 figure on a $300,000 property, they need to know that they have to have that before they even go out house hunting. And that's before down payment. Now, I also tell, newlyweds and first time home buyers, sometimes they've been on their job for 3 or 4 years. They don't even know that they can use their 401k for a down payment on a house, and it
Wow.
doesn't count against them. They don't have to pay penalties. They just have to pay taxes. So it's one of the few things you can take money out for that you don't get penalized is your primary purchase. And so you sometimes have to navigate that with home buyers. I'm always amazed at home buyers that don't attend a home buying seminar that's free or even provides lunch or dinner. It's like, go to a home buying seminar, learn, for 2 hours what the process is, because this is a huge process. And, people go to wedding events, to learn about, everything from napkins to forks to use and how, venues and stuff like that. They go to these webinars and seminars to get married. And it's a 1 day event, right? The wedding. I'm
Right.
thinking you're talking about a house you're going to live in for 5, 10, 15 years, and you're not even going to a 2 hour seminar. So I always tell them too, hey, attend free seminars, webinars, online classes. There's so much free stuff out there to attend or to watch. Sometimes it's already pre-recorded. All the MI companies have free stuff. There's a lot of down payment assistance programs that have an online class for 8 hours. Sometimes it's free. Sometimes it costs $75. I always say, if there's some sort of class that you can attend, do that as well.
Man, you just dropped a lot of gems. I would say this, if you don't mind, hit that AEIOU, because that to me.
Yeah, sure, sure. I wish I could put a chat here, but so your A is your appraisal.
Okay.
Your E is earnest money. Your I is inspection. Your O, if it's not new construction, is option fee. And the U stands for upfront. So what I usually write out on a sheet of paper is I write it out A, E, I, and I put what those things are, and then I put the dollar amounts. And then I cross a line over the U on where it says upfront, and I put the grand total. And that's how I explain to clients in a real, like on a napkin level, hey, you got to have this before you even step foot in a car to go out house hunting.
Right. I'm going to take that line. I'm going to start using that.
I, I want realtors to use it. That's why I brought this up.
Okay. And then the other one. Now, I'll be honest now. For me, prior to being a realtor, when I would hear about seminars, about home buying seminars, about down payment assistance seminars, now in my mind, I used to just correlate that with those ones who were trying to sell timeshares. I would be like, oh, that's okay. By going for this, oh man, they're going to try to force me that I must sign up for this. I must do this. So I used to be very skeptical. And then being a realtor for this many years, and being a mortgage underwriter, I try to educate people. But then I catch myself saying, oh my goodness, now I understand why people push the importance of going for some of these seminars. But I can also see from their perspective how they feel like there's a catch. I don't want to go for this because I just don't want you to try to sell me something at the end of the day. So everyone starts feeling like, I know you're not just doing this from the bottom of your heart. I know there's something you want to sell me, but I'm not interested. So they already go with that mindset. Now, how do you get them to just drop that wall and truly understand that it's important to educate yourself before you go into something as big as purchasing a home? How do you get them out of the mindset of going for seminars and really understanding the importance of the home buying seminars?
I mean, it depends on if you're doing the seminar or obviously you want to invite them to your own seminars and not invite them to someone else's. But there's a lot of online sales tactics, and there's a lot of online free government sites that offer actual webinars for free, no cost. So it would be smarter for you to have a list of nonprofit organizations, MI companies, if you're wanting them to see some free stuff that's pre-recorded. But in regards to attending like a webinar or seminar that you're doing yourself, It's all about marketing out there on social media and so forth to try and get that audience, or being very specific with an audience. I've done seminars, in-person seminars at Lone Star College out here in Cyprus for people that were in Cyprus ISD teachers. And we had the room packed with 28 teachers. And that was awesome. But again, it was someone had a connection with, huh?
I said, wow.
Yeah. So someone had a connection with the ISD, which you have to be careful because you're not allowed to mass market ISD email addresses. You have to do 25 at a time. So you got to be careful about doing any type of mass marketing through email because chances are it'll be spammed out. So you want to make sure you're doing, if you're going to do something like that, make sure it's very specific. Maybe for a company like we're the in-house lender for a couple actual large organizations here in Houston that we have an agreement with where we will go and do seminar webinars at those locations. And we've gotten a couple leads from doing that. I recently went to an engineering firm down in Clear Lake with Bob Christian. He was the realtor. I was the lender. The room was packed with, I'm not kidding, like 82 employees. The company actually provided lunch. We didn't have to provide lunch. So we were out $0 for the web seminar. And these engineers had wonderful questions. They were very, very green to home purchasing, very, very scared. So we were able to take some of those fears away. But I would say the importance of attending a webinar is to take down some of the fears that a lot of the buyers have in thinking about home buying or home purchasing, especially with some of the news that's out there. CNN and Fox and all the MSNBC is talking about build to rent. It's so much cheaper to rent. I'm like, cheaper to rent? Let's say it's $200 or $300. Um, okay, but if you own a house and you're earning 5-6% equity on the house every year, if the price is $400,000 or $500,000, that's more than a couple $100 a month that you're earning. I mean, let's take like $500,000 house times even like 5%. That's
Right.
$25,000 a year. Divided by 12, that's $2,083 in equity that they're earning if that's the percentage that they're earning on the home. Well, explain to me if you're paying $2,500 on a mortgage, or let's say it's $4,000 mortgage, but you're getting half of that back in equity every year. How is that somehow worse than paying rent of $2,500 a month that you get zero equity on, or you get zero money back from because you're paying someone else's mortgage? I mean, I have a tenant in one of my houses. He pays my mortgage. I have a 15-year note. My 15-year note earns me $800 of principal every month because it's a 15-year note. So if he's paying me $2,600, my mortgage is $2,600, but I'm making $700 in equity, not sweat equity. I'm talking real equity. Like money I'm putting in is going straight towards equity. Okay. Then who's
Right.
making money? I am. He's losing it. The tenant's losing money because he decided to be a tenant. He decided to pay rent. He makes $0 when he leaves that place. I think he's been in there 2 years. He told me this year he's probably gonna be moving. Okay, but for 2 years I made money. He didn't make money. He lost money.
Exactly.
That's just the way of the world. He decided to rent. I decided to own. Guess who's making money? I am. Now, if my property value was to drop, which in Houston rarely occurs, then I might be losing money. But on the average, in the area I purchased, the average, like actual equity positioning, that's sweat, meaning like it happens every year just by price points going up, is 5.5 to 7% a year for the last 15 years. Don't I wish I had bought more than 2 years ago? Hell yeah.
Exactly.
I would have bought that house for 250 instead of 350,000. So when people say, I think I'll just rent, I just don't feel comfortable owning a house. I'm like, you're paying 100% interest rate. They're like, what are you talking about? I'm like, you could pay 5 to 7% in the market in the last 10 years, but you're paying 100% because every dime you put in is going straight to the landlord. Landlord's the one making money. He is the one paying his bills with your bill. So it's all about interpretation, perception. But I've owned a house since I was 19. Someone had to convince me to buy at 19. It was my mentor. And when she told me, you need to buy a house, I said the same thing. I had the same fears you're talking about. And I was like, oh, my whole family has rented their whole life. I'm just going to keep renting. And she said,
Right.
you're going to build zero wealth by renting. by the third home I purchased, which is the one I've been in for the last 20 years, I had so much equity from the previous two homes to put into this house. And now I look at how much equity I have now, which is $400,000. I only paid $240 for my house. $240 20 years ago. It's a
Wow.
nice 4,000 square foot Coventry home on a lake in Old Katy. 240,000. That's what I paid.
Wow.
Now we're 600,000. Math on math. So I've done the math. I'm going to tell you one thing. Everyone on this call needs to listen. If I take the last 20 years and I take out how much I paid for improvements, I've done the math. I paid about a total of 150,000 in total improvements for the home in the last 20 years. That includes adding a roof to the backyard, some work I had to do to the home, flooring. I'm talking everything. Okay. So I'll take that out of the equity because I paid it in improvements. Okay. If I take what I have left over and I sold the house tomorrow and I paid off my mortgage, I paid off all the stuff I paid, it's $150,000. If I took the difference that I've earned in sweat equity and divided that out over the last 20 years, I have lived there for free. I've paid $0.
Wow.
Does that make sense?
Yeah.
Because all my mortgages would have been paid for by the sweat equity I earned. So when I tell people that, I'm like, I could look at the last three homes, exact same. Actually, my first house, I made money. I actually made more than what I paid in my mortgage payments because my mortgage payment was only $534 and I walked away with $30,000 in less than 2.5 years at age 22. You know what it's like to have a check in your pocket at age 22 for almost 30 grand?
Almost 30
Let's just
grand.
say I spent
Wow.
yeah, well, nowadays I would have saved it. Back then I blew it, but whatever. So
Wow. I'm at a loss for words because that's exactly what I try to echo to my clients to get them to understand the importance of taking that leap of faith and going into home ownership. And you've just broken it down so beautifully. And you used facts, you used numbers so they can actually see it and understand that look, the end justifies the means. So thank you so much. Let me ask you this. Just walk us through the process of getting pre-approved because there are times now once they say that they're ready to take this journey and then they just go to a website and try to get pre-qualified. I always get them to understand, no, you have to get pre-approved. And there's some who get so afraid, oh my goodness, they're going to do a deep search for my credits. Please walk us through. How does it work when you want to get pre-approved?
no problem. So I usually have an initial discussion with the client to get an idea of number one, like, is it just that one person I'm talking to, or is there going to be multiple people on the loans? That way I'm talking to all parties. And then I usually ask just some brief questions about credit, income, assets, liabilities, just to get an idea of, if they own a house, what are they going to do with the house? Are they going to rent it out or sell it? If they're new home buyers, do they have enough funds to close? Do they have the credit required to get the product they want? Some of them want to do 3% down. Well, that requires a higher credit score. So I look at the initial picture from like a really 30,000 foot view. And then that's a 5-minute discussion. So after 5 minutes, I have a pretty good idea of what we're going to be looking at after they fill out the application online. Then I text them the link, which takes 5 to 7 minutes to complete. I'm always told to people that say, I'll get that done this weekend. And they say that on Monday. I'm like, you could do this. I mean, not to be gross, but I'm like, you could be doing this when you're in the bathroom. I mean, that's how quick the application is. I'm like, as quick as you check your social media is how fast you could be doing this application. Some people think they have to go back and go through all their documents. I'm like, look, I want the information, right here off the top of your head. It can be estimations for income and for assets. I just need the information so I have something to work with. It's like I say, look, this is like when the doctor sends you in to do an x-ray so he can see what the x-ray looks like first. And then when you go back in the office, he's pointing things out and he has more of an idea of what to give you. He can't walk in the door and say, oh, well, you look pale, therefore you have this. He can't do that. He has to do tests. He has to do the x-ray. My x-ray takes 5 to 7 minutes to complete. I've never seen someone take longer than 10 minutes to complete it. And then it does ask for documentation afterwards. And people will call me and say, do I need to upload that now? I say, look, if you're self-employed, Yes, we need to see the tax returns. Why? Because what you think you make and what we think you make are two very different things, because the IRS looks at things one way and then you look at it another way. So a good example, I've got a roofer. Roofers make really good money on bank statements. On paper, like on the tax returns, they claim very little income because they have a lot of expenses.
Right.
But again, if we do a bank statement loan, which again, that's a product that we offer first time home buyers, second time home buyers, they're self-employed. They're like, what do I do? Give me your bank statements. It's a slightly higher interest rate, maybe a 1 point higher interest rate. But my God, we can actually get you a mortgage and you're going to have this much to play with. And so, and I'm not kidding. Like I've had people on paper on a tax return. This is a recent, like this week deal on tax returns. They would have qualified for 250,000. On bank statements, they qualified for $4 million. I'm not exaggerating.
What?
Like 4 million, because again, their bank statements show so much more income than what the tax returns show because they write everything off. And so, yeah, that's the variance difference between the two. It's incredible what we can do with those numbers. So that's why I'm always very, very adamant about pushing people to say to do the application, let me review it. Afterwards, people are always appreciative, but before they just have this fear. It's like when you go into the doctor's office, they give you the gown and you're having to like cover yourself up and you're doing
Right.
this thing because you don't want anyone to see what you don't realize is the doctor's seen it all. So there's nothing you're going to show that the doctor hasn't seen. And so I think people get that way when they're disclosing all their finances into an application. They're like, oh my gosh, I'm so exposed. Well, if you don't expose yourself financially, it's hard for me to give you direction. But every time I do give direction, people are so relieved. It's like going over the roller coaster and the roller coaster comes to an end, right? You're excited, you're scared on that uphill, you're excited on the downhill. And then when it's over, you're kind of relieved in a way, right? You're like, okay, it's over. That was exciting, but I could only stand that for a minute. That's the roller coaster ride of financing. Like, oh my God, I got to give the tax returns. Oh my God, I got to tell him how much money I make. Oh, he's going to see my credit. And then we go over the thing and then all this excitement for 2 minutes. And then guess what? At the very end, I'm like, you're done. You're safe. This is how much you qualify for. Here's your approval letter. Here's your numbers, which again, our company is one of the few companies that delivers not just the approval letter, but we also give the numbers immediately to the client so they know exactly what they're seeing. I don't like to do the whole, here's your approval letter, your interest rates TBD. And when you find a house, I'll actually show you the numbers. We don't pull that stunt. That's what a lot of lenders do. We immediately tell people their numbers because we want them to understand. We want them to interpret that. And then I set up a 45-minute discussion for all first-time home buyers. So if you were to look at Shelly's email when she sends out the approval letter with the numbers, it says, here's where you go to set up an appointment with Mr. Harrington. I have a Calendly link that has many options open for people to have that 45-minute discussion with me. I've got 3 of those later on today. And again, they go to my calendar, they set the appointment. I've got one for tomorrow at 9 a.m. I have one appointment available on the weekend. It's 9 a.m. on Saturday. So whoever gets it first gets it first. And it's a client, and they want to, every time I go through that 45-minute initial discussion after application, all I can say is the clients are super happy afterwards. They feel like they've got direction. They have a plan ahead of them. And they're like, oh my gosh, I thought this was going to be so painful, but now I know I have a plan. It's going to be awesome. So it's not like the dentist's office where you're talking to the dental hygienist and she's like, oh, it's going to be so nice. Doesn't everything taste so great? And then the dentist comes in with a needle and stabs you. That's not me. I'm not the stabber. Although there are some really good dentists that they shake your cheek when they stab you so you don't notice it. I like those dentists. They're very, very good.
Right.
But I like to be the good dentist that says, hey, look, surgery is not going to take long. We're going to put you under. I always like to put people under. I'm like, we'll take care of all the details. Let us worry about that. I think people worry about the details too much. I say, hey, look, the things you're focused on is how much are you coming to the table with? What is your mortgage payment? And what kind of paperwork do I need to get you? That's the only 3 things I want you to worry about. Let me and the realtor worry about the rest, and we'll lead you down the process. And when we need something or we need to tell you something, I promise you we're going to keep you informed. There's never going to be a question mark coming from you saying, well, what's next? And what's our next step? We're telling you the next step every step of the way.
Exactly. I could definitely attest to that. I have clients that were frustrated with their former lenders, and by the time they come to you, it's like smooth sailing. They're like, oh my God, this is even better. And then you even give them options. You show them, especially when it comes to whether it's the homeowners insurance, different things that you
Yeah.
really guide them to where they have options. They're like, oh my God, you're looking out for their best interest. And for me, that's why I always say people on my wavelength are the people that I like to work with. And you definitely are on my wavelength. Like, I look at it and I'm like, yeah, there's no question. You have to be on my wavelength. I commend you for that. Okay?
Thank you. I appreciate it, man.
No problem. Okay, now I was going to ask this. Now, say a scenario where there's a married couple and the husband is looking to buy a house, but it doesn't want his wife to be on the house he wants to buy.
So you're saying they're married. They're still married, right?
Yes, but he wants to buy.
Okay.
He doesn't want his wife to be on it. He doesn't want her to be a signatory on the loan. He just wants to buy the house for himself, maybe for an investment, and he just wants to do that. Can that happen? Or is it a must that regardless, the wife has to be on the loan?
The wife does not have to be on the loan, but she definitely has to be on the deed because we're in the state of Texas and we're a homestead property state. Has no choice. You have to add the wife to the deed if they're married.
Okay.
So she has equal rights to the property. That's just a state of Texas rule. So there are 6 documents she has to sign off on, which does include 2 documents that look like they're the loan documents, but it's the wife acknowledging that the husband is taking on a financial liability. That's it.
That's it.
But she is not financially liable for the property.
Okay. Now, another question is what's the required deposit on a mortgage?
Deposit?
Yeah. So, for example, somebody wants to get a loan and they hear all you need is 5% down. Now, most time when I'm talking to my clients, they assume that's it. It's just 5%. Now, when you try to explain to them that no, this is going to be the closing cost, now that's
Right.
when it throws them off. You mentioned earlier with the AEIOU, but that's
Mhm.
upfront costs. But now
Those are the
these are
estimates, yeah.
exactly. But now the closing costs, as opposed to what was initially disclosed as the 5% or the 3.5%. Just break that down so people can truly understand why the closing cost is usually different from what they were assuming is the initial cost.
Well, a down payment is giving the lender assertion as to what kind of risk factor that loan is going to be. So when they put money down, the lender is the one giving 95, 90%, 97, 96.5% of the sales price. They're giving those funds to the title company. The title company is turning around and giving that to the seller. The down payment portion is what the buyer is putting down. That's the other portion. So whether it's 3.5%, 5%, 10%, 20%, that's how much the money that's coming from the buyer side. Because the combination of the loan and the buyer side is in combination been given to the seller for the sales price of the house, right? Because the money's got to come from somewhere. So whatever portion the buyer is giving is what affects interest rates, whether or not they're going to have mortgage insurance, how high that mortgage insurance is going to be, and then of course what program they're going to get. So when you say 3.5% down, that's FHA, right? So the interest rate is going to be a slightly lower rate than conventional, but the mortgage insurance is higher because it's only 3.5% down. So it all depends on what program they can qualify for, number one. And number two, how much can they put down without affecting their bottom line in their bank account. So when people say, well, I only have to put 3.5% down, well, that's the first part. That's the down payment.
Right.
Then closing costs and prepaids. Well, closing costs, they vary. They just do. And when people are like, well, isn't there like a rule of thumb, 3%? Well, I'm like, if you're buying $1 million house and closing costs are static being they're the same regardless of how high or low the loan amount is or sales price. Well, if you're buying $1 million house, it might only be 1% or 1.5% of the $1 million. On $400,000 house, it might be closer to 3%. But if you have a $100,000 deal, well, the closing cost might be 5 or 6%. So I don't like to tell people a percentage unless I know what price point they're looking at. If they're looking at 3 to 400,000, 3 to 4% is a good rule of thumb because you got insurance, taxes, and closing costs. Now, the insurance and taxes, you'll hear the word referred to as prepaids. Well, why are they called prepaids? Well, you are literally doing a prepay for insurance and taxes and putting that into an escrow account, including your first year premium, which is paid up front on homeowners insurance.
Right.
And I have to then start explaining, well, insurance is in advance, taxes are in arrears. So you're just paying taxes from behind you. You're just paying insurance in front of you. Your mortgage payment is for the payment behind you. When you pay rent, it's for the payment in front of you. So you have to really kind of break it down for clients. What are they paying? Like some people are like, well, I have to pay rent through July, and I can't find a house till July. I'm like, well, let's take that for a second. July 1st, you owe rent through the month of July. But if you close anywhere in July on a mortgage, guess what? Your first payment is not due until September 1. You get to skip August 1st and move on because September 1, you're paying August 1st through September 1st. Whereas with rent, when you pay on July, you're paying July 1st through July 31st. So hence, on rent, you're paying in advance. On mortgage, you're paying in arrears. People say, well, why is that? Well, a mortgage company can't charge you interest until it's accrued. That's why you're always paying for the mortgage behind you, is because it was accrued behind you. You cannot prepay interest. It's not legal. It's not a simple interest loan. You can't prepay interest. So when people are like, well, can I pay 2 payments in advance? The answer is no, you cannot. If you make a mortgage payment and you decided to pay the following month on that, like July 1st, you want to pay July 1st, but I want to pay July and August. That's not how the mortgage works. It accrues every month. So you have to pay July 1st. And if you make an extra payment on July 1st, guess where that payment goes towards? It goes towards principal reduction because you can't prepay your mortgage payments. You can do it for rent, but you sure can't do it for a mortgage. So those are little things that I explain to clients when I'm explaining to them their fee sheet. I usually go over the fee sheet with them even before they find a house when they set up that 45-minute discussion with me after they've done the application. And I spend about 30 minutes explaining to them closing costs. There's some questions I asked for them in advance. Where are you moving to? If it's Pearland, we're going to be talking about 2 insurance policies because you have to have a separate wind and hail coverage from your insurance policy. If we're talking about moving into Magnolia or Tomball, then we're talking about really low taxes, super low taxes, like 1.7 to 1.9, which is much lower than a brand new neighborhood in Katy that might be at 3.7% taxes, difference of sometimes $300 to $500 a month. So I have to get a little specific with the clients to determine how much the closing costs are going to be. And then let's say the house is listed for 95 days and you come to me and say, Mike, I think we could probably ask for some closing costs. This house has been on the market for a while. It's a very particular type of house, requires a particular buyer. I'm sure the seller's aware of that. We could probably ask for a couple $1,000s in closing costs. I'm like, let's ask. Doesn't hurt to ask, right? If it helps our buyer come to the table with less money. But there are limitations of to how much you can ask for in closing costs. On FHA, it's 6% maximum contribution from a seller, which we don't even ever hit 6% because I would then tap into the down payment. But let's say it's $12,000 in closing costs. As long as the down payment is still the buyer's down payment, the seller could pay, let's say, all the closing costs on an FHA. But let's say the buyer's like, I like the interest rate and the first time home buyer program on the 3% conventional loan. Okay, conventional.
Right.
Well, conventional, if you're only putting 3% down, has a 3% max contribution from the seller. Well, they might not be able to pay all your closing costs on a conventional like they did on the FHA. And that's where these discussions get very more detailed, is when I'm sitting with the client saying, well, you qualified for this program and this program, but here's the benefits of this one. Here's the downsides of this one. And then they understand which one they need to go with or move forward with. So,
Man, that again, that deserves a round of applause.
It's so interesting because I would always explain to clients that, yeah, they could just pay additional towards principal, but now you've just broken that down to where they need to understand the reason why they can't pay forward when it comes to the mortgage. The only thing they can do is pay additional principal. They have to wait until the month is over, but they can pay for that month. That's right.
correct.
We're going to take that to the bank. That is so amazing. Michael, you really just blessed us with a lot of information. I mean, I'm pretty sure that people are going to be thrilled when they're watching this. Like, oh my God, they're going to be taking notes. I'm going to tell them, we need to charge for this. Okay, another question I wanted to ask you was with regards to newlyweds. Oftentimes, when they come together with different credit scores and different financial backgrounds, how would you advise a newlywed couple to navigate through some of this complexity?
So, unfortunately, this happens a lot. I get these buyers that the husband, and I'm just using an example, but husband comes and he's got, some baggage on his credit from medical collections or whatever. So let's say his score is 620. She comes along. She's a teacher, super conservative personality, has a 780 FICO score. Unfortunately, since the dawn of age, it has always been the mid score of the lower of the two borrowers. So the 620 is the one we're going to have to use versus the 780. Fortunately, when it comes to conventional loans, when it comes to the mortgage insurance, you can blend the scores, which is nice. Also on conventional, which is a really nice benefit, ironically, if his score was 580, this is the funny part. Let's say his score is 580 and she's got a 780. You can actually blend, as of Fannie Mae changed this like a couple of years ago, you could blend the two together for them to qualify only because he doesn't qualify on his own with a 580. You can blend those two scores together. And it's almost unfair because, again, if he had a 620 and she had a 780, the 620 is a qualifying score. So Fannie says, we're going to use 620. But if you had a 580, they'll allow you to blend. And the blended score is the score you're going off of, which that's the funny part. So, so the interest rate, everything else is figured off the blended score. So it's a new thing, but there are options. And a lot of people think there's no options. And they tell me all the time, well, he's got a credit issues. He's had credit issues for 5 years and we thought we couldn't buy it. I'm like, well, you didn't know the rules had changed a couple of years ago. And it's not something you can like find on Dr. Google.
Right.
So I'm always shocked at the fact that talking to us costs nothing to talk to me, costs nothing to talk to you, right?
Exactly.
Conversation. We don't charge a consultation fee up front. We get paid at closing. When you close and fund, that's how we get paid. That's how you get paid. That's how I get paid. So the irony is people don't use us like they should for information's sake. And it might be because they've talked to somebody else who knew nothing about, what they're talking about. Like I said, I've done this a long time. It's through experience that I can tell you all these different things that I've been telling you. I know you think this is amazing information, but it's because every day I'm dealing with one scenario after another. I mean, Shelly, my assistant, just texted me about a land deal that we're not going to be able to do because of debt structure and so forth. We deal with stuff like that every single day. But here's the thing. Imagine if that guy had gone out and bought the land without talking to a lender first, like
Right.
me. He just went to the bank, put 20% down on land, and then he doesn't even figure out that he can't do the construction loan and qualify for the house he was going to build on that land. So if he hadn't talked to me first, he would have bought a piece of land that he doesn't have the ability to build on. Can you imagine? Then you have to resell that land at a loss, most likely, because land's not easy to sell, right? So it's like if they don't talk to me first and get a game plan and make sure there is a possible game plan to even go towards, I mean, I might have just saved him thousands of dollars in headaches so that he could get to the point where he could buy the land, build on the land, and do what he needs to do. But he's got to put some other stuff first, right? So I have to present the picture and say, hey, look, you'll qualify, just not right now. You're going to qualify later, and here's why. So we have to have that discussion with the clients beforehand. Talking to, I hate to say it, but talking to like Zillow, lenders or Zillow realtors, or talking to, realtor.com, or talking to these online lenders like Rocket and Quicken Loans. I'm just going to say it. They have less than 1 to 2 years experience doing what they do. No one stays at Quicken as a loan officer, as a guy who's answering the calls. No one's going to stay in that job and stay in that job a long period of time. It's like saying that someone's going to stay at McDonald's for a career. Well, no, they don't. It's usually something in between jobs. Someone's a Walmart greeter. They're going to either they're elderly and that's what they want to do, or it's an in between job because they got to get they want to get to somewhere else. Well, that's what people that work at these online lenders are usually. They're not lifers or not career people. They'll come and work for me eventually when they have the experience and knowledge base that they need to work my end of the industry. But unfortunately, when people are talking to the Rocket Mortgage person, they just have a script. They have rebuttals. They have scripts, rebuttals, and managers to send you to if they can't answer your question. That's not fun. That's like going to, I hate to say it, but that's like going to a local clinic and dealing with a doctor that can't be a specialist because he only knows how to do general medicine for the last couple of years. He had to start somewhere, so he started a clinic. Or going to a hospital where you're dealing with a doctor that's got 25, 30 years of experience. And again, experience when it comes to doctors, it's the same thing with my industry. experience is extremely critical. I always explain to people, when Sully landed that airplane on the Hudson River and landed it safely on the river and everyone lived, I'm going to tell you, the guy in the right seat, he was left seat, he was the captain.
Right.
The first officer, which was in the right seat, he only had 38 hours in that specific airplane. He had the same amount of hours as Sully in the sky, period. He had like 20, 30,000 hours in the sky. I have 52,000 hours sitting in my cockpit. So if something goes wrong and birds come flying into my engines, you don't want the Quicken guy to be trying to figure out,
Oh,
well, I guess I should follow ATC and land this in New York somewhere. No, you want Sully. You want the guy who's got 30 some, I mean, I think he had like 10,000 hours in that specific airplane. So he knew everything there was to know about emergency procedures for that airplane. He had another couple thousand hours flying military off of aircraft carriers. So you think he was scared of water? He flew over water when he first started flying, period. So the idea in his head of landing that airplane on water didn't scare him. He knew it just came down to an angle of attack and that water was going to be rough. It's a lot rougher than obviously landing on land, but it was smoother than landing in New York City where everyone's going to die. So he made an immediate decision in less than 20 seconds to land that airplane on the Hudson. And everyone around him is telling him, here, go to Peterborough and land on runway 13. You know what he said? We will be on the Hudson. He made a decision in the cockpit, PIC, what means um, uh, um, pilot in command. He made the decision because it was an emergency procedure. Here's the thing. Sometimes most flights go perfectly great, but when something goes wrong, you have to have someone in the cockpit that knows what they're doing to take care of your situation. A lot of first-time home buyers, they're looking for someone like myself or another experienced loan officer. They just don't know where to find that person, which is why it's
right.
important to talk to you as a realtor. And you're the realtor saying, hey, look, I know you've gotten with Chase. I know you've gotten with Wells Fargo. These pre-approvals, they're pieces of paper. But I really want you to get with my local lender so you know exactly what you're going to qualify for, what kind of house we can go out and see. That way your eyes don't get too wide. We're highly focused on exactly what you guys will qualify for. And I don't know if I answered your question about the credit, but when it comes to credit too, we have opportunities to do things like rapid rescore. And what that is where let's say we run your credit through a what if engine. It's kind of like a magic 8 ball that we go like this. And then we look at the 8 ball and it's very accurate. So it tells us, okay, what if we paid off this credit card or paid down this credit card? What if we got rid of this one collection that's medical? And then we look at this little engine, it tells us exactly what the score would be if we did these things. We can also, in that same engine, say, well, here's the credit report. He's got a 640, but we really want to get to 680. So we say 40 points. We just put 40 points in there. And the computer, like AI, comes back and says, well, if he pays this credit card down to $550 and this one down to this, and this one down to this, and this one down to this, you'll get your 40 points. So we've got that capability to do that with our credit reports, but people don't know about that. They don't know that we have the ability to discern that. And so that's why it's really critical that we have that. So
Wow. Okay. That's amazing. So I hope everybody has heard that, because now there are ways in which you could better roadmap to getting your credit to where it needs to be. I want to thank you again, Michael, for everything and for dropping all these gems with us. I mean, you were absolutely amazing. And I will definitely be getting more clients to you because, I mean, sure everybody has heard this. Now you can clearly tell the reason why we go, to Michael Harrington with Cross Country Mortgage. Like, there is no questions asked. He knows his stuff. And thank you so much, Michael. Any last tidbits you want to give out? You want to give to the listeners?
I just, if it's buyers that are watching this, um, talk to a professional. It doesn't, like I said, it's not like you're paying some sort of consultation fee to discuss things with us. I get agents that sometimes have me talk to buyers 2 years before someone's going to be buying, just to give them some insights and know-how. And I just say, hey, look, pop me in your phone and just put the word mortgage. That way you remember to look up mortgage, because you're not going to remember my name in 2 years. You're not going to say, oh, I got to call Michael Harrington, but you will remember the word mortgage. And you look that up and you're like, oh, there's that guy. I do that with, I hate to say it, I do it too. I have the word painter, electrician, plumber. because I forget the names of these people that do a lot of work for me, almost sometimes yearly. I'm like, okay, I need a plumber, and I look up the word plumber, and it's got my 5 plumbers in there. And so I always tell people, look, just put me in as mortgage Mike or mortgage influencer. And number one, I really appreciate you allowing me to be on this thing.
Oh,
It's
thank you.
very awesome to be able to do stuff like this and talk to people. I hope this does get out there. Sorry if I bled a lot of information. I just feel like it's important that people know that.
No, I love
I mean,
that.
if we could do a webinar, I've got first time home buyer, that way it's more visual. They see the AIOU, they see like what mortgage insurance is and credit. I just tell people, look, bear all so we can see what it looks like. Let
Exactly.
us help you make the right decisions. And remember, I bought my first house when I was 19. I'm extremely wealthy in real estate because of starting at age 19. And my entire family never owned a home, and none of them are wealthy. My entire family on my mother's side, no one owned a home ever. And guess what? No one's wealthy. No, everyone's living check by check. And I tell people there's a major difference in mindset when you own a home, and they call it the American dream for a reason. When you own a home, your mindset changes. You're not temporary. Nothing's temporary now. You've got some permanency. You've got some foundation. Now you're going out looking for a church to attend. Now you want to know all your local restaurants, and you're going to you're going to become friends with all those restaurant owners and you're friends with your neighbors. It's a total mindset change. When you live in an apartment, you don't care about your neighbors. I'm just being honest. You don't care about your neighbors because you're there temporarily. Everything's temporary. You don't plan
Very
on
true.
being there for a long period of time. And then you have a temporary mindset with everything: your job, your stability with your faith, your stability with your family, because it's temporary. It's all temporary. But when you have a home, someone you're going to, place you're going to invite your family to for Thanksgiving, for Christmas, it becomes permanent. It becomes foundational. There's a reason why I personally have not moved in 19 years. And it's because of a childhood thing where I had 23 different schools I went to. My mom was very nomadic. We moved all the time. Um, I can tell you how to load a U-Haul truck in less than 3 hours because my mom would always get sideways with the landlord and we would always get evicted. I think we were evicted more than we actually left a place. And so I grew up in a very, very rough childhood where I never had friends because I never was in one school for a long period of time. I don't have best friends from junior high or from elementary. Have some friends from high school, but again, I lived with my grandmother during high school. So I always tell people when I lived with my mom, she was like a gypsy. She just moved everywhere every 3 to 4 months, and I never had stability. And I was the kid that can say I didn't have stability. So when people say, Michael, for a mortgage guy, you lived in the same house for almost 20 years. Why is that? I wanted my kids to have the most stable life. And
Right.
even if I had moved across the street, that's not stable for me. I've seen people in my neighborhood literally move from one house to the corner of the other part of the neighborhood. That tells me how much people love our neighborhood. We
Right.
only have 2 houses for sale in our neighborhood a year. Like 2 houses a year go on the market. Our neighborhood is amazingly small and very well kept, and just I have no reason to move. I mean, my mortgage is at 2.12%. People are like, well, that's why you got a mortgage. No, no, no. I started off my house at 7.5%, refied to 5.5, and finally refied onto a 15-year at 2.125. So when people are like, well, rates are too high, I'm like, it doesn't matter where the rates are. Buy the
Exactly.
house because eventually you're going to refinance and have that lower mortgage payment. But you got to get in first because and this is one thing I'll leave you with. If people don't buy now and they wait for rates to drop. The truth is, we're going to become in Houston just like Austin was 2 years ago,
Right.
where there was way too much, there was no inventory, way too many buyers in the market, and prices shot up almost 150, 200,000 on most homes, and people couldn't afford it. But people from moving from other parts of the country could afford it, and they were paying cash. They were paying over and above the appraised value. And guess what? Guess what?
Wow.
They're paying 7%, 6.5%. Here's the thing: when rates come down, all these buyers that have been waiting on the sidelines are going to jump in. There will not be enough inventory. There'll be multiple offers on every home. And you, as a client, as you, as a buyer, are going to pay too much for the house. And the cost of waiting is going to cost more on the price point of the house than having bought the interest rate today and refinance next year. So buy now, refi in the next couple of years when rates will come down. I'm almost sure of it. When rates come down, you'll refinance just like the rest of the world ever has. I have actually stood in front of a room of agents and buyers and said, raise your hand if you've ever refied. 99% of the room raised their hand. I asked the one person who didn't raise his hand, and he had never bought a house before. That's the only reason he didn't refi. Everyone else had bought a house and refinanced at some point in time. I said, so what's the fear here? It can't be interest rates because you've all refinanced. So tell me what your fear is. Well, rates. I'm like, the current rate right now is the average rate for the last 45 years.
Exactly.
It's the average rate for the last 45 years. When rates went down to 3 and 4%, do you remember the words? This is the lowest the rates have ever been in the history of interest rates. So people are comparing the lowest rates in the history of rates, with the average rate. And they don't even know about 18% rates like 1983 and 84. They have no clue, right? Our parents remember that. Yeah. I mean, so if a grandma or someone in their 50s or 60s buying a house, they're grateful for a 7% rate. Why? Because they had 18%. They know that 7 is not bad. It's not horrible.
Right.
If they're from overseas, like overseas, interest rates on cars average 15 to 20%. Interest rate on homes, if there's even mortgages, is like 15 to 20%. Like you go to Russia, you have to pay cash for a house. That's why no one lives in houses in Russia. Why? Even Putin lives in an apartment, okay? Houses are very rare. It's usually only ambassadors and people of very, very high influence in Russia. Like we're talking oligarchs and so forth in Russia. Everyone else lives in apartments, all apartments. I was in Moscow. Never once when I was in Moscow did I see a house. Not one house in Moscow. Big, huge apartment buildings. We're talking like the size of CIA building type apartment complexes. Falling apart on my end. You'll see cracks 18 stories high. And you're wondering, is this thing going to fall apart? So we don't have the gratefulness in this nation to understand that 7% on a house that you can write off as well on the interest and the taxes on the home. Like, let's say the net effect is 5%. You're paying 5% so you can own a piece of real estate. I mean, really, and you're complaining. So I tell people, look, if you need perspective, I will give you perspective. I can tell you all the rates I've ever paid for all my homes, all the rates. My first house was 7.5%. I did a 2-1 buy down with the builder where the builder paid for the buy down to 5.5 for the first year. It was 6.5 the second year. And the third year I paid 7.5%, which was the going rate at the time.
Well, right.
Do you think I was complaining? You know why I wasn't complaining? It's because the year before that, rates were 8.5%. So when they came down to 7.5%, perspective, rates are lower. Oh, this is exciting. The problem with today's society and the young people today, but rates were 4.5% 3 years ago. Well, yeah, they were the lowest they've ever been 3.5 years ago.
Exactly.
Ever. And they're at the going average interest rate for the last 40 years. But here's the thing. If you're making 3 to 5% in just equity on the home, you're writing off your interest, you're writing off your taxes, so you have less income you have to claim to the IRS. And the net effect is almost the same as what you're making in sweat equity. What's wrong with this picture? You're making money. So.
Exactly.
Well, Michael, man, sad to say, we've come to the end of the show. Thank you again for, this brilliant conversation. I mean, you have filled us with a lot of knowledge that I'm sure it's going to be something that people are going to really appreciate. And I want to thank you. And I hope you feel better, Hope you drink lots of water.
Thank you.
Thank you.
Yeah. Sounds good, man.
All right. No problem. Have a good one. Thank you, everybody.
All right, guys. Yeah.
Okay.
All right. Bye.